SpaceX is evolving into the world's first orbital AI backbone, but while that moonshot scales, legendary investor Michael Burry warns the current market is a 1999 bubble ready to burst.
ARK Invest CEO Cathie Wood and 5 other elite analysts like Cem Karsan and Snider are tracking structural shifts that most retail investors are completely missing.
We've used advanced AI to condense over 10 hours of high-level expert briefings into just minutes of actionable alpha.
You're about to discover why the S&P 500 pivot at 4,950 is the only number that matters right now, and how China's economic rot is about to flood global markets.
Today we're diving into some massive news from Cathie Wood and the ARK team regarding a potential partnership between SpaceX and the AI powerhouse Anthropic.
It's all about convergence. Cem Karsan highlights how SpaceX's launch dominance is becoming the physical backbone for Anthropic's advanced AI models.
Wait, SpaceX? The rocket company? Why do they need an AI chatbot like Claude?
Because, as Cathie Wood explains, if you want to run a global AI network without being blocked by terrestrial governments, you need to go to orbit.
Exactly. The alpha here is that SpaceX isn't just about rockets anymore. It's the distribution layer for the world's most sophisticated intelligence.
So we're talking about AI satellites? That sounds like something straight out of a sci-fi movie.
It's closer than you think. But while this looks like a slam dunk for SpaceX, there's a massive risk for traditional cloud providers like Amazon and Google that will hit in a few minutes.
The data suggests traditional fiber optic networks could become the horse and buggy of the AI age.
Cathie Wood's core thesis is that the cost to deploy AI hardware in space has dropped 90% thanks to reusable rockets.
Right, and Tasha Keeney points out that when you combine SpaceX's launch cadence with Anthropic's efficiency, you get a competitive moat no one can touch.
Hold on, 90%? Is that just for the fuel or the whole setup?
That's the cost per kilogram to orbit. It makes putting massive compute power in space actually profitable for the first time.
Cem Karsan argues that Starlink is the secret sauce here. It provides the low-latency data pipes that Anthropic's Claude needs to function globally.
Exactly. Instead of waiting for a signal to bounce through underwater cables, it's a straight shot to the satellite.
Wait, is space internet really faster than the fiber optic cable in my backyard?
In many cases, yes, because light travels faster through the vacuum of space than through glass cables.
So, Anthropic gets a speed advantage and a distribution advantage all at once.
Okay, so SpaceX is basically building a giant brain in the sky. Got it.
Tasha Keeney notes that SpaceX's ability to land and reuse Falcon 9 rockets is a game changer for AI hardware.
Right? Most satellites stay in space for 10 years and get outdated. SpaceX can launch new AI chips every few months.
So they can basically upgrade their space computer as fast as I upgrade my phone.
Exactly. They aren't stuck with hardware from 2015, while the world is moving to 2025.
It's iterative hardware at scale. That's a concept Cathie Wood has been pushing for years.
That sounds like a nightmare for anyone trying to compete with them.
Cathie also emphasizes why Anthropic is the choice here. Their focus on constitutional AI and safety.
When you're running critical infrastructure from space, you can't have an AI that's hallucinating or going rogue.
Constitutional AI? Does the robot have to swear an oath to the flag or something?
Close. It means the AI has a set of core principles it can't violate, which makes it more stable for high-stakes aerospace tasks.
It's about reliability. You don't want your satellite network taking creative liberties with its orbit.
Yeah, oops, I hit a space station isn't a great look.
ARK's research suggests Starlink's revenue could explode to $30 billion once it transitions from just internet to an AI service provider.
If they capture even 5% of the global AI inference market, those numbers might actually be conservative.
30 billion? That's more than some major airlines make in a year.
And with much higher margins since they own the rockets and the satellites.
So SpaceX isn't just a transport company. They're becoming the world's largest ISP and AI host simultaneously.
So I should probably stop thinking of them as the rocket guys.
Looking ahead, Cem Karsan believes SpaceX's valuation could realistically blast past $500 billion as this Anthropic partnership matures.
It's the Tesla model all over again, vertical integration that eats entire industries.
Wait, 500 billion? That's $500 billion. Is there even that much money in space?
The money isn't in space. The money is on Earth, paying for the intelligence provided from space.
It's a global utility play. Every company on the planet could end up being a SpaceX customer.
Okay, that's a lot of zeros. I'm starting to see why Cathie is so bullish.
Cathie Wood suggests investors watch SpaceX's launch cadence as the primary indicator for how fast this AI mesh is scaling.
More launches mean more compute in orbit. It's a direct correlation.
So if I see more rockets going up, that's basically the AI getting smarter.
Precisely. Every Falcon 9 is a server rack for the sky.
We also need to watch Anthropic's adoption in the enterprise sector. If big companies move to Claude, the SpaceX infrastructure becomes essential.
Keep an eye on their API usage stats and partnership announcements with other aerospace firms.
Got it. Watch the rockets, watch the chatbot, and hope I don't get left behind.
Spoken like a true investor. Let's see if this orbital gamble pays off. Today we're dissecting a massive warning from Michael Burry, who says the market looks exactly like the final months of 1999.
Nick Gerli's analysis backs this up, showing that concentration in the S&P 500 is at levels we haven't seen since the dot-com bubble burst.
Wait, the big short guy? If Michael Burry is comparing this to 1999, should I be moving my money into a mattress?
Maybe not a mattress, but Burry is pointing to the same passive bubble dynamics that led to a massive tech wipeout back then.
Nick Gerli points out that just 10 stocks now represent over 30% of the entire index value.
30%. So if those 10 companies have a bad day, the whole market basically faceplants.
Precisely. It's the ultimate all eggs in one basket scenario.
And while stocks like Nvidia keep climbing, Nick Gerli warns that the air up there is getting very thin. Michael Burry believes we're in a passive bubble where index funds are forced to buy the biggest stocks regardless of their price.
It creates a feedback loop. Nick Gerli notes that as more money flows into passive funds, it automatically pumps up the top 10 stocks, making them look unstoppable.
Hold on. So people are buying these stocks just because they're already big? That sounds like a circular firing squad.
It is until the selling starts. When everyone tries to leave the theater at once, that passive floor disappears instantly.
Look at the numbers. The top 10 stocks account for 33% of the market cap, which Nick Gerli compares to the peak in March of 2000.
Exactly. Back then it was Cisco and Microsoft, today it's Nvidia and Apple. The names change, but the math is the same.
Wait, 33%. Wasn't it like 20% just a few years ago?
Yep, it has consolidated rapidly. We are seeing record-breaking top heaviness.
Nick Gerli draws a direct line between Nvidia's current trajectory and Cisco's rise in 1999.
Cisco was the picks and shovels play for the internet back then, just like Nvidia is for AI now. When Cisco crashed, it lost 80% of its value. Then
80%? I thought Nvidia was a sure thing, because everyone needs their chips.
Everyone needed Cisco's routers too. The problem isn't the company, it's the price people are paying for it.
Michael Burry's point is that overvaluation eventually meets reality, regardless of how good the tech is.
So being a great company doesn't mean it's a great stock at any price. Got it.
Nick Gerli highlights that while the S&P 500 hits new highs, fewer individual stocks are actually participating in the rally.
This lack of breadth is a classic warning sign. It's like a building where the penthouse is being upgraded while the foundation is crumbling.
Wait, what does breadth actually mean for a regular investor like me?
It means the average stock is actually flat or down. Only the giants are keeping the index afloat.
Exactly. If the giants stumble, there's no support from the rest of the market.
So the market is basically just 7 companies in a trench coat.
Current valuations are sitting around 28 times earnings, which is significantly higher than the long-term average of 15.
Michael Burry is looking at these multiples and seeing the same irrational exuberance that preceded the 2008 housing crash.
28 versus 15. That seems like we're paying double for the same amount of profit.
That's exactly what it is. You're paying a premium for hope, and hope isn't a strategy.
Nick Gerli notes that when these multiples compress back to normal, it usually happens very quickly and painfully.
So we're basically waiting for the gravity to kick in.
If the 1999 parallel holds, Michael Burry's data suggests we could see a 30 to 40% drop in tech-heavy indices.
Nick Gerli warns that the Magnificent Seven have the most room to fall, given how far they've disconnected from their fundamental earnings.
40%? That's not a correction, that's a crater.
In 2000, the Nasdaq fell 78%. 40% is actually the tame version of what Burry is hinting at.
Burry predicts that when the selling starts, passive index funds will be forced to sell the biggest stocks to meet redemptions.
It's the reverse of the pump. The more people sell the index, the more the top stocks get hammered, which makes the index drop more.
So the thing that made them go up is the exact same thing that will drag them down.
Exactly. It's a momentum trap. Once it flips, it's very hard to stop.
Nick Gerli emphasizes that liquidity disappears exactly when you need it most.
Note to self, find the exit before everyone else notices the smoke.
Nick Gerli suggests watching the equal-weighted S&P 500 to see how the average stock is actually performing.
If the equal weight index starts dropping while the main index stays high, that's your final warning shot from Michael Burry.
Equal weight. So I should check if the other 493 stocks are doing okay?
Exactly. They're the true health of the economy, not just the AI hype train.
Michael Burry has historically moved into cash or defensive sectors when he sees these bubbles peaking.
Nick Gerli notes that high-yield savings or short-term treasuries are finally paying decent rates while you wait for a better entry point.
So I don't have to be all in on tech right now? I can just wait.
Patience is a position. Sometimes the best move is not playing a rigged game.
As Nick Gerli says, it's better to miss the last 5% of the upside than to be there for the first 50% of the downside.
I think I'll take the not losing half my money option. Thanks.
Today, we are dissecting the market carnage with insights from Matt deWolf, the host of Trade Brigade.
Matt is tracking a major gap down today, specifically looking at how the S&P 500 is slicing through key levels.
Wait, a gap down? Is that like when my bank account hits zero before payday?
Essentially, yes, but for the whole market, Matt's seeing price action skip over levels entirely.
And the big reveal, if the S&P doesn't hold 4,950, we're looking at a serious slide.
Matt deWolf's main takeaway is that the 4,950 level on the SPY is the line in the sand.
If it stays below that, he says the madness is just beginning. It opens the door to much lower targets.
So if it stays below that number, I should probably hide my portfolio under the bed.
Maybe just keep a close eye on it. But stay tuned, because Matt also has a specific level for the Nasdaq that could trigger a surprise bounce. Matt deWolf points out that the market is opening significantly lower, breaking past psychological support.
Exactly. Opening below 4,950 on the SPY changes the entire technical structure from bullish to bearish.
Hold on, why is that specific number so important? Did Matt just pick it out of a hat?
Hardly. It's a key prior breakout point. Below that, there's a lot of empty space for the price to fall.
So it's like falling off a cliff after losing your footing.
Great, and I forgot my parachute today.
Matt deWolf is also laser focused on the Nasdaq, specifically the QQQ.
He's looking at the 396 level. If the tech sector can't find buyers there, the sell-off accelerates.
396? Is that a lot for the Nasdaq?
It represents a significant percentage drop from the recent highs. It's where the big institutional players might step in.
And if they don't, Matt thinks we head toward the next support zone much faster.
So tech stocks are basically on sale, but the store is on fire.
The VIX is also popping. Matt notes a 15% jump in the volatility index today.
That's the fear gauge. When it spikes 15%, it means traders are frantically buying protection.
Wait, people buy protection for stocks? Like insurance?
Precisely. Put options are getting expensive right now because everyone is scared.
Matt suggests that this expansion in volatility often leads to more erratic price swings.
So, it's going to be a bumpy ride. I'll grab my motion sickness pills.
Matt deWolf discusses two scenarios for a gap down like this: the gap and go or the gap and trap.
A gap and go means we open low and keep selling. A gap and trap means we trick the bears and rally back up.
I don't like the sound of being trapped. Who gets caught?
Usually the people who sell right at the open, without waiting for confirmation.
Matt's advice is to watch the first 30 minutes of trading to see which one it is.
30 minutes. I can wait that long, maybe.
Looking ahead, Matt deWolf has a pretty grim prediction if we can't reclaim that 4,950 level.
He thinks we could be looking at a retest of the 4,800 area on the SPY.
4,800. That's a huge drop from where we were.
It is. It would be a full-blown correction, wiping out weeks of gains.
Matt's reasoning is based on the lack of structural support between these two levels.
So it's like a long slide down a slippery hill.
Matt is also predicting that the US dollar index will continue to put pressure on stocks.
Right? A strong dollar usually makes stocks look less attractive. It's an inverse relationship Matt watches closely.
Why does a strong dollar hurt my stocks? Shouldn't a strong dollar be good?
Not for multinational companies. It makes their overseas earnings worth less when they bring them home.
So if the dollar keeps climbing, Matt says stocks will have a hard time recovering.
Great. The one time the dollar is strong, it's ruining my retirement fund.
So what's the game plan? Matt deWolf suggests the 30-minute opening range rule.
Basically, don't do anything for the first half hour. Mark the high and low of that period.
30 minutes of doing nothing. That's my specialty.
If the price breaks above that range, Matt says it might be a gap and trap. If it breaks below, it's a gap and go.
It's a simple way to stay on the right side of the momentum.
Okay, so I just need a timer and some patience. Got it.
Finally, Matt wants everyone to remember that 4,950 is the ultimate pivot.
He's not looking for long trades unless the market can actually get back above that level and hold it.
So it's the gatekeeper? No entry, unless we pass 4,950.
Exactly. Staying below it is bearish. Getting above it is the only way to save the day.
According to Matt's analysis, fighting the trend below that level is a recipe for disaster.
I think I'll just stay on the sidelines and watch the show then.
Today we're diving into the mind of Cem Karsan, the founder of Chi Volatility Advisors, who says the stock market isn't what you think it is anymore.
Exactly. Cem argues that it's no longer about earnings or news, it's about the plumbing of the market, specifically options and flows.
Wait, the plumbing? Are we talking about leaky pipes or the S&P 500?
Both, in a way. Cem's analysis shows that the structural mechanics of how stocks are traded are now the primary driver of price action.
Cem Karsan's big takeaway is that volatility isn't just a side effect, it's the thing that's actually eating the market.
Right. He points out that derivatives volume has exploded so much that the tail is now wagging the dog. Stocks move because options dealers have to hedge.
Hold on. So you're saying my Apple stock moves because some guy in a basement bought a call option?
In aggregate, yes. Thousands of those trades force big banks to buy or sell billions in shares to stay balanced.
It's a massive feedback loop. But while this drives the current melt-up, Cem warns of a specific liquidity trap coming in the fourth quarter.
A trap? Great. Just when I was starting to like this melt-up thing.
Let's talk about the monster in the room, 0DTE options. Cem Karsan notes these now represent nearly 50% of all option volume.
It's insane. These are options that expire in less than 24 hours. They create massive concentrated bursts of buying or selling.
Wait, 0 days? That sounds like gambling, not investing.
It essentially is. But Cem's point is that this gambling is so big it forces the rest of the market to react to it every single day.
So the market is basically reacting to 24-hour noise on a massive scale.
So the plumbing is basically a fire hose at this point.
Cem dives deep into Vana and charm flows. Essentially, as time passes or volatility drops, dealers have to buy back stocks.
It creates a systematic bid. Even if there's no good news, the market can keep drifting higher because of these mechanical requirements.
Vana? Charm? Are we talking about economic terms or characters in a fantasy novel?
Haha, they're Greeks. Mathematical variables. But for us, it just means there's a hidden force pushing prices up regardless of the economy.
Until the liquidity dries up, that is.
Right, because nothing goes up forever, especially if it's just math pushing it.
Looking ahead, Cem Karsan predicts a major shift in the fourth quarter. He sees a collision between the election and a lack of liquidity.
He thinks the current calm is deceptive. Once we hit that window, the same mechanics pushing us up could pull the rug out.
So you're saying the plumbing might burst right around election day?
Precisely. Cem's model suggests that dealer positioning becomes very unstable in late October and November.
It's a high probability window for a 10 to 15% correction, according to his flow analysis.
10 to 15%. That's not a leak, that's a flood.
Cem's advice? Don't just watch the news, watch the VIX and dealer positioning.
If you see the VIX starting to trend up while the market is still at highs, that's your signal that the charm is wearing off.
So if the VIX goes up, I should probably put my helmet on.
Exactly. Cem suggests using these overextended periods to buy protection when it's still cheap.
Because when the flows turn, they turn fast. Thanks to Karsan's insights, we at least know where the exits are. Today, we're diving into Jeff Snider's deep dive from Eurodollar University on China's massive economic shift after the third plenum.
Yeah, Jeff points out that Xi Jinping is basically ditching the old property-driven growth for what they call new productive forces. Think high-tech manufacturing.
Wait, third plenum? Is that like a secret meeting of supervillains?
Close enough. It's the big meeting where the Communist Party sets the economic course for the next 5 years. And according to Jeff Snider, the course they've set is a risky one.
The big takeaway from Jeff's analysis is that China is trying to build its way out of a slump, even though their own people aren't buying anything.
So they're making stuff with no one to sell it to. That sounds like a recipe for a garage sale disaster.
Exactly, except the garage sale is the entire global market. Jeff warns that this manufacturing focus could lead to massive global trade tensions.
And while they focus on chips and EVs, the property sector, the thing that holds 70% of household wealth, is rotting.
Jeff Snider argues that China's biggest weakness is that 70% of its citizens' wealth is locked in real estate that's losing value.
It's a massive drag. Imagine if your house lost value every month, but you still had to pay the mortgage on a place that might never even be finished.
Hold on, 70%? If my bank account was 70% Beanie Babies and the market crashed, I'd be panicking too.
That's exactly what's happening. Jeff notes that without a property bailout, the Chinese consumer is essentially hibernating. Jeff highlights that the government isn't coming to the rescue of homeowners. Instead, they're pouring money into factories.
Right, they've chosen new productive forces over the old productive apartments. It's state-led industrial policy on steroids.
So they're ignoring the house fire to build a new shed in the backyard.
Precisely, and Jeff warns that this move leaves the domestic economy in a deflationary spiral.
Jeff Snider points out a major imbalance. China's industrial output is growing, but people at home aren't buying.
Since domestic demand is dead, all those goods, EVs, solar panels, chips, have to go somewhere else. They're flooding the global market.
Wait, if they're flooding the market, does that mean my next car gets cheaper?
Maybe, but Jeff explains that it also means factories in the US and Europe can't compete, which leads to tariffs and trade wars.
It's China Shock 2.0. We're seeing the fallout in real time as prices for manufactured goods plummet globally. Jeff also mentions that China actually stopped or modified how they report youth unemployment because the numbers were so bad.
It was over 20% before they changed the math. When you have that many young people without jobs, social stability becomes a concern.
Wait, they just changed the math? Can I do that with my credit card statement?
I wish. But Jeff's point is that hiding the data doesn't hide the reality. These kids aren't out buying apartments or starting families.
And that reinforces the deflationary cycle Jeff keeps talking about. No jobs means no spending.
A huge part of Jeff Snider's thesis is the eurodollar, specifically China's lack of dollar liquidity.
Right. Without a steady flow of dollars, the PBOC can't just print their way out of this without trashing the yuan.
Dollars? I thought they used yuan in China.
They do, but to trade with the rest of the world and manage their banks, they need US dollars. Jeff argues the world is facing a dollar shortage, and China is feeling the squeeze.
So they're trapped. They can't stimulate the property market properly, so they double down on exports to get those dollars back. Jeff Snider is skeptical that China will hit its 5% GDP growth target this year.
He argues that manufactured GDP from government spending doesn't reflect the true struggling economy on the ground.
5% sounds pretty good to me, though. Most countries would kill for that.
For China, 5% is the bare minimum to keep the wheels from falling off. Jeff's data shows that underneath the surface, things are cooling fast.
If they miss that target, expect the government to get even more aggressive with their industrial subsidies. Jeff predicts a surge in global protectionism as a direct response to China's overproduction.
We're already seeing it with EV tariffs in the EU and the US. China is forced to export deflation to keep its factories running.
Wait, so the rest of the world is basically going to build a wall around China's exports?
Effectively, yes. Jeff notes that this export-at-all-cost strategy is hitting a wall of global politics.
It means higher tensions and more volatile markets for the foreseeable future.
Jeff Snider suggests keeping a close eye on the yuan. If it starts slipping, it means the dollar pressure is winning.
A weak yuan makes their exports even cheaper, which just pours gasoline on the trade war fire.
So if the yuan drops, my stuff gets cheaper, but the world gets more chaotic.
That's the trade-off. It's a key signal for currency traders and global investors.
Jeff also points to commodities like copper and oil as the truth-tellers of China's actual growth.
If China is truly booming in new productive forces, copper demand should be through the roof. If prices sag, the boom is just propaganda.
Got it. Copper is the lie detector for the Chinese economy.
Exactly. Follow Jeff Snider's lead, ignore the speeches from the third plenum, and watch the market data instead. Today, we're unpacking a warning from Cameron Dawson, the Chief Investment Officer at New Edge Wealth, regarding this relentless market rally.
Cameron's analysis suggests that while the indices are hitting record highs, the risk of a ferocious reversal is actually intensifying every single day.
Wait, ferocious. That's a pretty strong word for a market that's been going up and up, isn't it?
Exactly, and that's the point. The higher it zooms without a breather, the harder it potentially falls. Cameron says the S&P 500 is now trading at a forward price-to-earnings multiple of 21.
In her discussion with Adam Taggart, Cameron noted that we are seeing extreme concentration, where a handful of tech giants are doing all the heavy lifting.
So if those big tech guys trip, the whole thing comes down.
That's exactly the alpha here. High valuations plus narrow breadth equals a fragile floor.
And while everyone is betting on a soft landing, we'll see why Cameron thinks the Fed might actually throw a wrench in those plans later in our breakdown. Cameron Dawson points out that the S&P 500 has hit a 21 times forward earnings multiple, which is historically very expensive.
It is. Unless earnings grow by 15% or more, that valuation is hard to justify without assuming interest rates drop to zero.
Hold on. 21 times earnings. Is that like paying $21 for a lemonade stand that only makes $1 a year?
That's a great way to put it. You're paying a huge premium for future growth that might not actually show up.
And it's not just the price, it's who is leading. Cameron highlights that the top 10 stocks now make up over 30% of the total market cap.
30%. So if those 10 companies have a bad week, my whole portfolio is toast.
Pretty much. Cameron calls it a thin rally. If the AI hype cycle cools even a little, there's no safety net underneath these valuations.
It's like building a skyscraper on a foundation of toothpicks. According to Cameron's data, the market is pricing in earnings growth of at least 10 to 12% for the rest of the year.
Right? And if we see any margin compression, meaning costs go up faster than sales, those targets become impossible to hit.
Wait, if companies are already expensive and they don't hit those huge targets, does that trigger the ferocious reversal she mentioned?
Exactly. When expectations are this high, even a good earnings report can lead to a sell-off if it's not perfect. Cameron also warns that the market is still fighting the Fed. Investors want 6 rate cuts, but the Fed is signaling maybe 2 or 3.
Adam Taggart noted that this disconnect creates a massive liquidity risk if the Fed stays hawkish.
So the market is basically a kid asking for 6 cookies, and the Fed is a parent saying, maybe you get one.
And the market is already acting like it has all 6 cookies in its pocket.
There's also the lag effect. Cameron mentions that many companies haven't felt the sting of 5% interest rates yet because they locked in low debt years ago.
But that debt starts maturing soon. When they have to refinance at 7 or 8%, that's a massive hit to their bottom line.
So we're basically waiting for the bill to arrive in the mail.
Exactly. Cameron sees 2025 as the year that bill finally comes due for a lot of mid-sized firms.
Cameron predicts that a 10 to 15% correction is necessary just to bring valuations back to historical averages.
She doesn't think it's a if, but a when. The more the rally zooms higher without a dip, the more violent that correction will be.
15%? That sounds like a lot of money disappearing very quickly.
It is, but she views it as a healthy reset. Right now, there's just too much froth in the system.
Cameron also expects the VIX, or the fear gauge, to jump significantly from its current lows.
We've been in a period of eerie calm. When the VIX spikes above 20, that's when the panic selling usually begins.
So we should be looking for the VIX to start climbing as a warning sign.
Precisely, it's the smoke before the fire.
Based on Cameron Dawson's outlook, the smart move is building some dry powder.
She suggests having 10-15% in cash. That way, when the Ferocious reversal happens, you aren't a victim, you're a buyer.
So wait, I shouldn't be all in on tech stocks right now?
Cameron's data says definitely not. Rebalancing is key here. Finally, Cameron advises focusing on quality. That means companies with actual earnings and very low debt.
If interest rates stay high, those are the only companies that will thrive, while everyone else is struggling to pay their loans.
Quality over hype. Got it. No more buying stuff just because I saw it on a meme site.
That's the best financial advice you've had all day.
To kick off, let's recap what each guest had to say. Cameron Dawson highlighted that the rally currently being seen is quite fragile.
That's right. She argued that it's largely underpinned by speculative trades rather than solid economic fundamentals, which could lead to a swift downturn.
So, it's like the party is happening, but the walls could come crumbling down at any moment.
Exactly.
Next up is Snider, who points to vulnerabilities within the property market as a red flag.
Jeff argues that if the property engine fails, we might see a broader market stall, emphasizing that real estate isn't just housing, it's about overall economic health.
So, if properties start failing, it's like the game of Jenga, where one piece taken out sends the whole thing tumbling.
Precisely. Losing the property engine could have domino effects throughout the economy.
Lastly, we have the legendary Michael Burry warning about the passive investing bubble.
Burry believes that the trend of investing without active decision-making could spark a market crisis reminiscent of past bubbles. It's about the lack of critical analysis.
So he's basically saying people are buying stocks like they are collectibles without considering their real value.
Exactly. It's a serious wake-up call for investors.
Interestingly, despite their different focuses, all three guests agree on one critical point: the risk of a market correction.
That's right. Cameron points out the fragility in current rallies, Jeff highlights the weak property sector, and Michael warns about the passive investing bubble. They're all seeing warning signs.
So no matter what angle they're taking, it's like they're all saying, be careful.
Exactly. It's a resounding caution from each of them. All three also highlight the dangers of speculative trading, which can fuel volatility.
Cameron says speculative investments drive up prices unsustainably. Jeff adds that this kind of trading can exacerbate downturns, and Michael underscores that passive investing makes it easier for speculation to thrive.
So all three think that playing with fire could lead to some serious burns for investors.
Exactly. They're all sounding the alarm here. Now, let's dig into some disagreements. Cameron believes a market correction is just around the corner.
In contrast, Jeff sees this as a more gradual process, pointing to the property market as a key influencer.
So one says it's happening now, while the other says slow your roll, it'll happen later. How does that shake out?
Exactly. Cameron's ready for the markets to fall, whereas Jeff thinks there are still some underlying strengths to hold it up for a bit longer.
Then, there's Michael, who's really concerned about the long-term implications of passive investing.
Cameron is more worried about immediate market fragility and the effect of speculation. Michael's view is about the underlying shifts, whereas Cameron focuses on what's directly in front of us.
So one is saying, watch the little tremors, while the other is saying, look out for the big quake coming.
You got it. They're looking at different time frames and implications. If you found these expert insights useful, don't forget to give us a like and subscribe.
We bring the latest financial analysis right to your screen, saving you the legwork. No one has time to wade through all that data.
Seriously, after hearing all this, I feel like I've got a degree in market dynamics.
Stick with us for more cutting-edge discussions, and see you in the next video.